Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The equity market finished at record highs today, despite a pickup in underlying U.S. inflation in the month of July. The core consumer price index was up month on month by 0.3%. Services prices rose more than the goods that may have been impacted by those tariffs. And that news helped to support the price of Bitcoin. In a moment, we'll take a look at the crypto space. I'll be joined by Peter Chung, head of research at Presto. But we begin here in the States. Joining me now is Charles Lieberman. He is co-founder, also the CIO at Advisors Capital Management. Charles is on the line from just outside New York City. Chuck, thank you so much for making time to chat with me. What did you make of the CPI data?
Well, I thought it was a bit of a relief for the market. Investors were kind of nervous that the news would be worse, that some of the tariffs would flow through very visibly into the CPI data. Fortunately, the impact looks like it was relatively modest. I think it is there. If you look at the trend in the good side of the economy, that's upward. But nonetheless, the core number was a little bit high, but the overall number was on the soft side. So I think the market was relieved that the news was not worse. And that's why the market rallied so strongly.
Do you have a sense of what it may do to the thinking at the Fed?
Well, I think it frees them to go by 25 for sure. But it might even lead to 50. It depends on whether or not they want to throw an olive branch to the president. They did misjudge the economy, as we all did. The last employment report was just absolutely a shocker. What we thought we knew about the economy, that growth was continuing at a very solid pace, turns out not to have been the correct evaluation. It looks like we hit a soft patch for a number of months, undoubtedly due to concerns about tariffs and the impact of tariffs. And so firms were a little slow to hire. So economic growth was a lot weaker than expected. And that justifies a rate reduction. And of course, they didn't do that in advance. They only found out about this after the revisions. And so to make up for it, they might feel that 50 basis points is appropriate. A lot will depend on upcoming data.
So if we can agree that for the moment the tariffs are not being passed on to consumers, are we to understand then that profit margins are under pressure quite a bit?
Not clear. We do have data for the second quarter, and those profit margins were fine. Corporate profits did very, very well. So I would say that's certainly not the case for the data that we have. Looking forward, it may be that some of the tariffs are being absorbed by the producers, the manufacturers overseas. That won't hurt U.S. profit margins. But it may also be that the third quarter will be a little weaker than we expect because the profit margins might be squeezed a bit.
We also had word that tariff revenue reached a fresh monthly record for the month of July, I think somewhere in the magnitude of about $28 billion. Do you think this is sustainable, the rate of revenue that the government is going to kind of collect as a result of these tariffs, or are we going to deal with maybe something that tapers off a little bit as we kind of get adjusted to this new paradigm?
Well, there'll certainly be some adjustment because certainly importers will choose to import from wherever they can get goods at the lowest cost. And so it's impossible to adjust the supply chains that quickly. And so initially they may be getting from the original source, in which case the tariff levels are running hot. But as they adjust and as deals are cut, by the way, between the U.S. and other countries, some of those tariffs may come down. So for both of those reasons, it wouldn't surprise me if the flow rate, the run rate for tariff revenue comes down a bit.
Are you already seeing evidence that tariffs are having an impact on trade flows, kind of a rerouting of how goods are beginning to flow into the U.S.?
Absolutely. In fact, the most glaring example is there was a sharp decline in Chinese exports to the U.S., but a significant increase in exports from other parts of Asia. So it sure looks like a lot of Chinese goods are being transshipped through other countries. And that, of course, is also subject to change because the administration knows about it. They've talked about it. And they may impose tariffs on some of those transshipments.
And now part of the tariff strategy is to engender maybe a little bit more reshoring of American manufacturing. Do you think that's really picking up some traction right now, or is that something that we're going to have to wait for more evidence of?
Oh, I think that'll take years. You just can't turn on domestic manufacturing easily, certainly not if you have to build new plants. Some increase in production is possible from existing facilities. If consumers, for example, are deterred from buying a Mercedes or a Jaguar or a Toyota that's manufactured overseas, they can always increase domestic production a bit to satisfy that shifting demand. But there are limits and there are capacity constraints. And so I think the true shifting, the ultimate source of all of these products will definitely take time.
After the bell, we had news from the cloud services provider CoreWeave. Losses were steeper than expected. This company is continuing to build out to meet demand from AI developers. And one of the takeaways here is that CoreWeave, even though revenue did triple to around $1.2 billion, capital investment was $2.5 billion. So obviously, the company seems to be responding to very strong demand for data center capacity. How are you feeling about the AI trade right now?
Well, there are parts of it that we feel reasonably comfortable with. For example, we're looking at utilities that will supply energy to these data centers. I've got some investments to take advantage of that. The actual construction of these facilities will take some time. And the market, of course, has anticipated a lot of this. So there are lots of parts of the market that reflect very, very strong growth in AI and all of the suppliers and the key components of it. So the market's priced for a lot of growth. The real question is how much growth will take place relative to expectations. If it turns out to be stronger than expected, these stocks could turn out to be cheap. And of course, if it isn't, if the actual increase in output is less than expected, or the profitability is less, then these stocks are very expensive. It's what makes the investing in AI and some of the chip sectors really difficult.
So we had records today for both the S&P 500, the NASDAQ 100, and even the NASDAQ Composite. Right now, I'm looking at the valuation on the composite index at around 35 times earnings. Historically, I think we can agree, Chuck, that seems to be pretty expensive. Are you alarmed by that?
I wouldn't say alarmed, but I definitely see it as expensive. And that's why I made some of the comments that I made earlier. It really depends on how large the sector becomes and how profitable it can become. I find the valuations to be quite expensive, very optimistic. And so I'm personally not comfortable with investing in some of these companies. And I don't feel like I have to because if you exclude the top 10 PE multiple stocks in the S&P 500 and you go to the unloved, disliked, hated, ignored, choose your adjective, 490, the S&P 490, there are lots and lots of great values in that part of the market. And those companies are doing perfectly well. They'll continue to grow. They will prosper. And in a healthy economy in which AI does well and technology does well, the whole rest of the economy will come along. So I feel there are safer ways to invest right now.
Chuck, you have been in the markets for quite some time, and I'm wondering whether or not you're a bit concerned by the degree to which the White House is becoming more involved with things like the Fed and Fed policy, trying to influence that outcome, even what's been going on with the Bureau of Labor Statistics. Does that concern you at all?
Absolutely. It's quite inappropriate. I don't like seeing it. It's not consistent with my view of how the Fed operates. I worked at the Fed twice in my career. These are professionals. They're not going to intentionally make concessions to the president or for politicians in general. There may be one or two individuals who might be influenced. That's always possible. But even, if, for example, with the president appointing the chairman of the Council of Economic Advisors to the Federal Reserve Board, and he's clearly on board with what the president wants. Nonetheless, he's simply one vote. And there are a lot of people on the board who are first and foremost going to be concerned about the legacy that they leave in terms of how they ran monetary policy. And they're not likely to sacrifice themselves for political considerations.
Chuck, we'll leave it there. Always a pleasure. Thank you so very much. He is Charles Lieberman, co-founder, also the CIO at Advisors Capital Management, joining from just outside of here in New York City on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Last week, President Trump signed an executive order to clear the way for digital assets to be added to the mix of investments available in workplace retirement plans. Now, this, needless to say, is an historic shift, and it's being viewed as a major victory for several industries, including cryptocurrencies. Those companies looking to tap some of the roughly $12.5 trillion held in retirement accounts. For a closer look now, I'm joined by Peter Chung. He is head of research at the quant trading firm Presto. Peter's on the line from Hong Kong. It's always a pleasure to have a chance to chat with you, Peter. Thank you so much for making time. I want to point out right out of the gate here that this executive order also eases access to private equity and real estate and some other alternative assets as well for those 401k plans. Give me your take on this and what you think it represents for the industry. Obviously, a huge boon, right?
That's correct, yes. So, what this is going to do is it's going to allow these retirement savings to maximize a risk-adjusted return. The Portfolio Theory 101 tells you that a way to raise expected return of your portfolio without raising risk is by adding an uncorrelated asset to your portfolio, and crypto is one of those assets. So it's a big win for the retirement savers, but also a big win for the crypto industry as well.
There's also the Genius Act to talk about. And one of the things the act will offer is more of a boost for the stablecoin industry. And I'm wondering whether you believe that this necessarily creates some competition for the crypto space when you're looking at a digital asset like Bitcoin.
Actually, I think it's very complementary to an asset like a Bitcoin because what it allows is that if the stablecoin becomes a mainstream instrument, it becomes a lot easier for the users of stablecoins to trade it for Bitcoin because I think up until now, if you wanted to buy Bitcoin, you have to transfer your funds from a legacy banking fiat-based system into the on-chain assets like a Bitcoin through centralized exchanges like Coinbase or also with the help of the legacy banks as well. Now, once you get your assets on a stablecoin, it's because both stablecoin and Bitcoin are in the assets that operate on the blockchain. Basically what it means is that those two, you're dealing with the two assets that operate at the same wavelength. So, trading in and out of Bitcoin is going to be far easier, activities than if it is done without the help from the stablecoin.
You don't believe that the perception, given the fact that stablecoins are backed by U.S. Treasuries, T-bills primarily, you don't think that that's going to create in and of itself a greater degree of confidence? And as a result of that, maybe take a little bit of business away from the Bitcoin type market, the cryptocurrency market?
No, I don't think so. Because stablecoin is basically, it's a tokenized version of US dollars. So if you're somebody looking to protect yourself from inflation or currency debasement risk, you're not going to do that by just simply staying with US dollar pegged stablecoin. You want to move your assets away from US dollars into an asset whose supply is constant, fixed, and is not affected by arbitrary monetary policy of the central banks. And so therefore, yeah, I mean, if you're somebody who's concerned about maintaining your purchasing power, and protecting your family from the currency long-term devaluation, yeah, you got to move into an asset like a Bitcoin.
What about market volatility? That's something that really we haven't seen much of lately. Is there a reason for that? And do you believe the risk of market volatility has been removed somewhat from the Bitcoin market?
You're actually right. If you look at over the long run, the volatility of a Bitcoin has come down compared to, let's say, 10, 15 years ago. And I mean, there could be many reasons behind it. Obviously, it's a lot more mature asset now. Also, with the participation of institutional investors, it's less vulnerable to the rumors or retail hypes. So all of things, I think, helped dampen the volatility of a Bitcoin, and I think it's a good thing. I think for the broader public, these ups and downs of Bitcoin has been of a turnoff for getting involved with this asset class. But yeah, now that the volatility of Bitcoin is, I think it's similar to similar to the crude oil volatility now. So it's a lot more manageable, and I think that's going to attract more people into this asset class.
Peter, we'll leave it there. Thank you so very much for being with us. Peter Chung is head of research at the quant trading firm Presto, joining from Hong Kong here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.